We have a machine, we've given it a job, buy stocks when it's pulled stocks far above fair value. But unfortunately, it's largely a mirage. Shorts are largely an extinct species on Wall Street at this point. This has become so dominant that it's created elements of effectively the everything bubble, right?
In a recent statement, he indicated that the algorithmic capital flows behind passive investing are fueling an everything bubble in the United States. This trend has not only driven stock prices far beyond their fair value but, more alarmingly, has allowed this illusion of wealth to seep into various asset classes, including real estate. Yet most people remain unaware, continuously funneling their retirement savings into the self-reinforcing spiral.
I think it's important to distinguish between being bearish on the economy and bearish on markets, right? So one of the things that I've been very clear on is that as long as flows into passive vehicles, as long as Americans have retirement plans and the majority of the assets are being allocated to passive vehicles, that what many describe as that mindless robot is effectively sucking stocks up, right? We have price discovery in terms of where transactions have to happen. It's really not telling us anything about the state of the economy or the actual behavior of the individual securities as much as it's telling us about the flows that exist in the market. So I just want to make sure that it's very clear that it's, bearish on the economy and bearish on the stock market are two very different things.
Explain how potentially inflated asset prices might be masking some of these risks in the economy.
Well, I don't think it's just masking. I actually think it's contributing to the behavior in the economy. So just very quickly, you are somewhat familiar with the work that I've done around passive. The idea is very straightforward. How we invest actually influences the outcomes that we see. And approximately 20 years ago, the United States and its retirement plans settled on the idea that the safe, rational investment for people to buy was the index fund. And when you buy an index fund, you're buying a market cap weighted index. Most people think that means that it should have no real impact. And the actual definition of passive investing is somebody who never transacts, who always holds. Right, that's the theoretical academic definition of it. The problem is that in order to get in to hold, you have to buy. And in order to get out, you have to sell. And so you're not a passive investor at all. What you are is a systematic algorithmic investor in which you've chosen a particular methodology for how to invest. Now, the problem is because it is market cap weighted, and market cap doesn't necessarily scale with liquidity. A company like Apple is 100 times the size of a smaller stock in the S&P 500. It probably only has about 10 times as much liquidity. And so when the large orders go in to buy something like an Apple or an Nvidia, they're pushing that price up more than they are other stocks. As they become larger and larger within the index, they receive more and more of that allocation. It creates a spiral effect where both the flows and the concentration actually feed back to create the behavior that we're ultimately seeing. We have a machine, we've given it a job, buy stocks when I give you money. What stocks should I buy? The ones that are in the index. At what price should I buy them? Whatever price is available, right? And that creates an inflation that ultimately pulls stocks, and has pulled stocks far above fair value. Most people will observe this and think that it's tied to some form of mania. I think it's much more frightening that it's really tied to Americans who are not thinking about their portfolios, who are simply engaged in the behavior that we've been told makes sense, which is to dollar cost average in at higher and higher prices. That makes us feel good. It looks like our wealth is inflating, but unfortunately, it's largely a mirage.
Is there some sort of tipping point that you anticipate? Because I know passive investing is about 50% of the market, or a little over
50. It's a little over 50% now.
Over 50%. Are we going to get to some point where something breaks because of all this passive investing?
The quick answer is yes, right? Finding that point is actually quite hard because, among other things, as passive investing grows, what's called the competitive response, right? The reaction to those overvalued securities are supposed to cause people to be more aggressive in selling them. That theoretically would increase the supply and push the prices back down. But as the passive share grows, the proportion of investors who can actually react to those prices and stand in opposition to it shrinks, right? Shorts are largely an extinct species on Wall Street at this point. Most value managers are also extinct simply because valuations have been lifted far above what they would consider to be rational. And so they are naturally hesitant in a market that has taken on runaway characteristics, as you might expect with those feedback loops.
How come you don't think more investors are aware of these passive investing risks? Because most of the people I know, they have work-related retirement accounts, and all their extra capital goes into these index funds.
Yeah, that's the answer, unfortunately. Is that what we have been taught is that it is passive investing, right? That we ultimately are just participating. You can't actually just participate. You are an active participant in the market. You are making a buy decision, even though you've outsourced it to an algorithm. So the simple answer is that we've done a disservice over the past 20 to 30 years. We didn't actually understand how the market reacted to flows. Well, I think unfortunately that what we have seen is by and large, this has become so dominant that it's created elements of effectively the everything bubble, right? The inflated valuations, among other things, are providing wealthier individuals with the resources to buy homes without taking out mortgages. They can use a brokerage account loan at far lower interest rates than mortgages typically. It's secured as collateral against that. That's helped many young people and coming from wealthy families to obtain homes, even though home prices remain very elevated. Right. So we're seeing a level of elevated home prices. We're seeing elevated valuations and prices within the equity markets.